Hi everyone, this is Steven, and welcome to this Wealthy Education video on advanced technical analysis. Today we're going to be talking about the exponential moving average, which is a trend indicator. So the EMA is a weighted moving average, which gives more importance to near-term prices. So a simple moving average is simply taking the sum of several time frames, adding them together, and then dividing by the number of time frames. With the exponential moving average, we give more weight to the near-term prices. The way we use the exponential moving average is we take two moving averages, one a fast or signal line, and one a slow line. The fast or signal line has a low number of time frames, and the slower line has a higher number of time frames. And what that means is, let's say we take a 20-day and a 50-day exponential moving average. So the 20-day is going to be faster than the 50-day. So our 20-day is our signal line, and it will cross above and below the 50-day, and that will give us our buy or sell signals. A golden cross is when a short-term time frame crosses a much larger time frame. So the golden cross that's often referred to by the media is the 50-day crossing the 200-day. And that's especially important when it happens in a market average, such as the S&P 500. So let's take a look at the exponential moving average on a chart and how we can apply it in different time frames. Let's look at an exponential moving average in a chart of Wells Fargo. We're going to use a 5-day and a 30-day exponential moving average. You can keep the spread between your moving averages closer if you want to take more trades. But the wider you put the difference between your moving averages, the fewer trades you'll get, but the more reliable the trades will be. So depending on the frequency of the trading that you want to do, you can vary that distance between your exponential moving averages. Here we have the stock in a downtrend. We have a bottoming price action right here around 51. So it bounces off this support level now 3 different times. And then the stock moves above a resistance level here around 53. As the stock moves up, our exponential moving average, our 5-period or 5-day in this case, moving average moves above the 30-day for a buy signal. The stock begins an uptrend. It dips on a retracement, but it finds support at 53. So we have 2 support levels here at 53 now, and bounces again. And when it bounces, you get another buy signal on your exponential moving average as your 5 crosses your 30-day. And then you end up with a sell signal as the 5 crosses below the 30-day here when the stock is around 58. Let's put in a Fibonacci line beginning with the low here in April and going up to the high. And we'll see where the stock traded on our Fibonacci line. So this is the 50% line, and this is our 61% line, which is our golden, or 61.8% line, which is our golden ratio line. So we can see that the stock traded up, and when we got the sell signal, it traded down and retraced to that 61.8% level, and then bounced off of that level. So we had a bounce off of our Fibonacci line, and then the stock failed and broke through that 61.8% level, which was another sell signal. You already had a sell signal indicated with your exponential moving average. And then the stock traded down before finding support again at our next Fibonacci level. So now that we have support at these levels, we're going to look for the 5-day EMA to cross back above the 30-day before we have the all clear to get back into the stock from the long side. Now let's take a look at this in a smaller time frame and look at it on an hourly basis. What's going to happen is our EMA will change from a 5-day to a 5-hour and a 30-hour. So we can take more trades on an hourly basis, but we can still use our Fibonacci levels in combination with our EMA. Here's that bounce off support at the 61.8% level. So if we were trading on an hourly basis, we could have taken this trade and gone short when the stock turned down and broke through the first Fibonacci level, and then looked to cover at the 61.8% level, here down around 53. So by using the EMA in combination with the Fibonacci, we get our sell signal, and then we use our Fibonacci level as an indicator to cover our short. We can then pay attention to the EMA as the stock bounces. It moves, our 5-hour moves above the 20-hour, but then crosses back below the 20-hour. So we have another sell signal as our stock comes back down to that 61.8% level. We could have purchased the stock here, expecting another bounce, but then as the stock continued through, we had a really close stop because we know that's a Fibonacci level that if the stock penetrates through that level, we don't want to be long at that point. So we have the EMA at a sell in combination again with the Fibonacci level, but in this case, that support level does not hold. So we would have a tight stop here, as we know that's the level that we're trading against. So that's the EMA in combination with Fibonacci lines in 2 different time frames. Thank you for watching this video on the exponential moving average. In our next video, we're going to be talking about the moving average convergence divergence indicator, or the MACD. I look forward to seeing you in the next video.